There are at least 5 bills the average American over the age of 65 is still paying every single year that they are not legally required to pay. 5 bills. And before I go one sentence further, I need to clear up the single biggest misunderstanding about this, because it's the reason most people click away and leave thousands of dollars sitting on the table. People assume a video like this is only for one kind of senior. Either they figure it's only for low-income folks who are struggling, so if they're comfortable, they tune out. Or they figure it's some advanced wealth trick, so if they're living mostly on Social Security, they tune out. Both of those are wrong, and I want to be crystal clear right now. This list is for both of you. Whether your whole income is one Social Security check, or you've got a pension, some savings, and a home that's tripled in value, there is real money on this list with your name on it. On every single one, I'll tell you exactly which group it helps and how, so nobody watching can say, this isn't for me. Now, here's why almost nobody tells you about these. It's brutally simple. Every single person whose job it is to collect that money from you has a direct financial reason to keep their mouth shut. Your county does not call to tell you that you can freeze your property taxes. The Social Security Administration does not remind you that you can stop the withholding coming out of your check. The tax preparer charging you $300 does not lead with the fact that you may legally qualify to have that exact return done for free. The money stays where it is, unless you stand up and claim it. In the next 20 minutes, I'm going to walk you through all 5, one at a time, in plain English. And then I'll add 3 bonus moves at the end for the retiree who's built up some money, because those last 3 can be worth a small fortune, and almost nobody talks about them. Here's the one idea that ties this whole thing together. Being legally exempt from a bill and actually not paying it are 2 completely different things. The law does not refund you automatically. Nobody mails you a check. You have to know the rule exists, and you have to claim it. That's the entire reason this video exists. Now, a word on who I am and why you can trust these numbers, because it's the opposite of what you usually hear. I'm not a licensed advisor, and I'm not going to pretend to be one. This is education, not personal financial advice. But here's the thing. I don't ask you to take my word for any of it. Every single number in this video comes straight off an official .gov page, and every one of those links is in the description below this video, so you can check it yourself. Most channels ask you to trust the person. I'd rather you trust the source. So stay to the very end, because the last bill and the 3 bonus moves after it are the ones that quietly cost people the most money, and some of them are the easiest of all to fix. Let's start with the biggest one. Bill number 1 is your federal income tax. And I need you to really hear this, because for millions of seniors, the correct amount of federal income tax you owe going forward is far lower than what you're paying. And for a great many of you, it's 0. And you're still paying it, or still having it withheld, out of pure habit and fear. Here's what changed. There's a new law, the one you've heard called the Big Beautiful Bill, and inside it is something called the Senior Bonus Deduction. Starting with the 2025 tax year, the one you file in early 2026, every person who is 65 or older gets an extra deduction of up to $6,000. If you're married and you're both 65 or older, that's $12,000. And here's the part that makes it so powerful. That $6,000 stacks on top of everything you already get. It sits on top of your regular standard deduction. It sits on top of the extra standard deduction seniors have always gotten for being over 65. You don't have to itemize. You don't have to give anything up. It is simply added on. Now here's who it helps, and it's both groups. If you're a lower income senior living mostly on Social Security, stacking these deductions very likely pushes your federal income tax all the way to 0. And it may mean you don't even need to file. And if you're a comfortable middle-class retiree, you're not left out either, because this deduction is available in full to single seniors with income up to $75,000 and married couples up to $150,000. It only begins to shrink above those numbers and doesn't fully disappear until you're over $175,000 single or $250,000 married. So the only people this truly leaves out are the genuinely wealthy. And one more thing that makes it urgent: this is temporary. As the law stands today, the senior bonus deduction is only here for 2025, 2026, 2027, and 2028. 4 years, unless Congress extends it. So this is a claim it now, every single year while it exists thing. If you use tax software, it asks your age and applies it. If someone prepares your return, you make sure they applied it. That's bill number 1, and it's the single most valuable point in this entire video. Do not pay federal income tax you do not owe. And that leads straight into bill number 2, because it's the other half of the same coin. Bill number 2 is the tax on your Social Security benefits. Now, a lot of people believe Social Security is always taxed, and a lot of others believe it's never taxed. And both are wrong. Here's the actual rule. Whether your Social Security gets taxed depends on something called your provisional income, which is basically your other income plus half of your Social Security. There's a lower line and an upper line. If you're single and that number comes in under $25,000, or married and it's under $32,000, then 0% of your Social Security is taxable. None of it. As your income climbs, more of the benefit can be taxed, up to a maximum of 85% for higher income retirees, which means even at the very top, 15% of your Social Security is always tax-free. So here's the win for each group. If you're a lower income senior, there's a very good chance the correct tax on your Social Security is 0. And that new senior deduction we just talked about makes that even more likely. And if you're a comfortable retiree with more income, I'm not going to insult you by pretending it all disappears, but the right planning can still drop the taxable portion to a lower tier. And here's the mistake that hits everyone, rich or poor. When people file for Social Security, a great many of them check a box on a form called the W-4V, telling the government to withhold federal tax out of every single monthly check, just to be safe. Then, a big chunk comes back as a refund the next year, if they remember to file at all. Think about what that actually is. You're letting the government hold your money with no interest all year long, on tax you may not even owe. The fix is simple. You look at your real numbers or have someone look at them with you, and you file a new W-4V to right size or stop that withholding, so it matches what you'll actually owe, and not $1 more. Pay what you owe on time and not 1 cent early as a gift to the Treasury. That's bill number 2. Bill number 3 is the one that makes people genuinely angry once they find out, and it's your property tax. Now, I want to be precise here because this is exactly where seniors at both ends get told they don't qualify, when very often they do. The truth is, there are really 3 kinds of senior property tax relief, and between them, they cover almost everyone. The first kind is income-based, often called a circuit breaker, and that one is aimed squarely at lower and fixed income seniors. If your income is modest, this can knock your property tax down dramatically, and in some places, it can be deferred almost entirely. The second kind is a flat senior exemption that knocks a chunk of value off the top, regardless of income. And the third kind, the one comfortable retirees always assume they're too well off for, is an age-based freeze with no income test at all. Let me give you the clearest example. In Texas, once you turn 65, your school property taxes are frozen at the level you paid the year you turned 65. Your home value can double. Your frozen tax does not go up, and there is no income limit on that freeze. It doesn't matter how comfortable you are. You qualify because of your age, period. And Texas is far from the only state with a freeze like that. But here's the catch that costs everyone. None of these are automatic. Your county does not look at your birthday, see that you turned 65, and apply the discount. You have to file, and almost every one of these programs has a hard deadline, often early in the year. Miss it, and you pay the full bill that year and wait until next year to try again. Why won't your county chase you down to claim it? because every dollar of relief you claim is a dollar of revenue they lose. So you make one phone call. You call your county assessor's office, or you search your county's name plus the words senior exemption and freeze, and you ask two questions. What relief do you have for homeowners over 65, and which of those is based on age with no income limit? That one call has been worth hundreds, often thousands of dollars a year. That's bill number 3. Bill number 4 is your Medicare premiums, and there are actually two completely separate overpayments hiding in here. Conveniently, one helps the lower income retiree, and the other helps the higher earner. First, the lower income win, and it's a big one. There are real programs called the Medicare Savings Programs with names like SLMB and QI. And if your income is limited, they will pay your Medicare Part B premium for you. In 2026, that Part B premium is about $203 a month, nearly $2,400 a year, taken straight out of your Social Security check. These programs can cover that entire premium. And there's a related one called QMB that goes even further. By federal law, doctors and hospitals are flat out banned from billing a QMB enrollee for most Medicare costs at all. Most people who qualify never apply because nobody tells them. You apply through your state's Medicaid office. Now, the higher earner win, and it has a name that sounds like a person. It's called IRMAA, the Income-Related Monthly Adjustment Amount. It's a surcharge they pile on top of your Part B and Part D premiums once your income crosses certain levels. By definition, this one only hits people with a solid income. And here's the trap inside the trap. The income they use isn't this year's. It's your tax return from 2 years ago. So picture this. You're 64, 65, still working, earning a good salary. Then you retire and your income falls off a cliff. But 2 years later, Medicare looks back at that old, high tax return and hits you with a surcharge based on money you're no longer earning. People just pay it because it shows up as a quiet deduction from their Social Security, and they assume it must be correct. It is not necessarily correct, and there's a form to fix it. It's called the SSA-44. When you've had what the government calls a life-changing event, and retirement is specifically on that list, along with the death of a spouse, divorce, or a drop in income, you file that form, you show them your income has fallen, and they recalculate your premium based on your real current situation. That single form has put thousands of dollars a year back in retirees' pockets. Almost nobody files it because almost nobody knows it exists. That's bill number 4. Bill number 5 is the one that's going to feel almost personal because it's the fee you pay just to deal with all the others. Bill number 5 is your tax preparation fee. Every year, millions of seniors walk into a storefront tax office or a big-name chain and pay somewhere between $200 and $500 to have a fairly simple retirement tax return prepared. And a great many of those people legally qualify to have that exact same return prepared for free by people the IRS itself has trained and certified. There's a program built specifically for seniors called TCE, Tax Counseling for the Elderly. It's an IRS program for people 60 and older, and it specializes in exactly the questions retirees have: pensions, Social Security, retirement account withdrawals. The biggest provider of it is AARP Tax-Aide, which runs thousands of sites across the country, and you do not have to be an AARP member to use it. On top of that, the government now has its own free online filing options for people comfortable doing it themselves. Now, here's the honest line, and it applies to everyone. If your situation is genuinely complicated, a business sale, rental properties, a complex estate, then yes, pay a real professional. It's worth every penny, and I'd tell you to do exactly that. But if your return is straightforward, 2 Social Security checks, a pension, maybe a few investment statements, you should not assume you have to hand a chain $300 for 45 minutes of data entry when the law has already built you a free, qualified option and your age makes you eligible. That's bill number 5, and it's one of the easiest to act on this year. Now, I promised you 3 bonus moves, and I want to be straight about who these are for. The 5 bills I just covered reach across every income level. These last 3 are specifically for the retiree who's built up something: a home that's appreciated, an investment account, a healthy IRA. If that's not you, don't feel left out. The first 5 already had you covered. But if you have built up something, these 3 can be worth more than everything else combined. And the low-income videos never mention them because their audience can't use them. You can. Bonus move number 1 is the tax on selling your home. Here's the fear that lives in people's heads. You bought your house decades ago for $60,000. It's worth $400,000 now, and you're terrified that if you sell it, the government taxes you on that enormous gain. So you don't downsize. You stay in a house that's too big and too expensive because you're afraid of a tax bill. And in most cases, that tax bill does not exist. There's a rule called the home sale exclusion. If you've lived in your home as your main home for at least 2 of the last 5 years, you can exclude up to $250,000 of gain from tax if you're single, and up to $500,000 if you're married filing jointly. Gain, not sale price. The gain is what you sold it for, minus what you paid, minus the improvements you put in. So that couple whose home went from $60,000 to $400,000 has a gain of about $340,000. And as a married couple, they can exclude $500,000. Their federal tax on that sale is 0. They were sitting in a house they no longer wanted, scared of a tax that was never going to hit them. Bonus move number 2 is for the retiree with money in regular investment accounts, stocks or funds that have gone up in value, and it's one of the best kept secrets in the whole tax code. It's called the 0% capital gains bracket. When your taxable income is low enough, the federal tax rate on your long-term capital gains is not 15% and not 20%. It's 0. For the 2026 tax year, a married couple can have taxable income up to roughly $98,900 and still pay 0% on their long-term gains. And for a single person, that line is around $49,000. And that's taxable income, your income after your deductions come out. So a couple bringing in well over $100,000 total can still drop into the 0% zone after the standard deduction and the senior bonus, and sell appreciated investments without paying a dime of federal tax on the gain. Retirees are in the perfect spot to use this, because in the years after you stop working and before large required withdrawals kick in, your income is often at its lowest. That's the window. A smart retiree harvests gains in those low-income years on purpose, completely tax-free, instead of letting it all pile up and get taxed later. Bonus move number 3 is for anyone 70 and a half or older who gives to charity, even a little, and has money in a traditional IRA. It's called a qualified charitable distribution, a QCD. Once you're 70 and a half, you can have money sent directly from your IRA to a charity, up to $111,000 a year. And that money is completely excluded from your taxable income. Now, you might say, I already deduct my donations. Here's the thing. Most retirees today take the standard deduction, which means their giving earns them no tax benefit at all because they're not itemizing. The QCD fixes that. The money never shows up as income in the first place, which is even better than a deduction because it lowers the income number that everything else is based on. Your Social Security taxation, your Medicare surcharge, all of it. And once you reach the age where you're forced to take required minimum distributions, a QCD counts toward that requirement. So instead of being forced to pull the money out, pay tax on it, and donate what's left, you send it straight to the charity, satisfy your required withdrawal, and pay no tax on any of it. If you give to your church or any cause, and you have an IRA, this is one of the most powerful tools you've got. So let me tie all of this together with the one idea that matters more than any single rule I just gave you. In every one of these cases, the law already says you're exempt, or you qualify, or you don't owe. The senior deduction is in the law. The Social Security rules are in the law. The property tax relief is on the books in your own county for the modest income senior and the comfortable one alike. The Medicare appeal form is sitting on the government's own website. The free tax help is funded and waiting. The home sale exclusion, the 0% bracket, the charitable distribution, every one of them is real, but not a single one of them is automatic. The government does not refund you for a rule you didn't claim. No one mails you a check for the deduction you forgot to take. The entire system is built so the money stays where it is, unless you stand up and claim it. And it does not matter whether your income is small or comfortable. There is a version of this list that is overcharging you right now. The people who collect these bills are counting on one thing, and it isn't that you're dishonest, and it isn't that you're careless. They're counting on the fact that you assume the relief is for someone else. The struggling senior assumes the good stuff is for people with money. The comfortable senior assumes the relief is only for people who are struggling. And so, both of them keep paying. That's the whole game. So do one thing for me. Send this video to one person in your life who's over 65 or getting close. A parent, a neighbor, a friend from church. It doesn't matter if they're getting by on a single check or sitting on a paid-off house and a nest egg, because the odds are very good that they're paying at least one of these bills right now for no reason at all. And one share from you could be worth more to them than any gift you'll ever give. Remember, every source is linked in the description, so check your own eligibility, and then go get what's yours. If this helped, subscribe, so you don't miss the next benefit most seniors overlook. I'll see you in the next one.